crypto dominoes still falling, hearkening back to Luna Terra last year and FTX and 3AC and Celsius and all of the implosions. And what I said to him is, if you think about it, first of all, just think about crypto. The Bitcoin blockchain and Ethereum, those two blockchains have not skipped a beat. There have been no transactions interrupted. The smart contracts, which are rules-based, when there's a margin call, a stock goes down or something drops in value, there's an automatic margin call. It just happens automatically in this over-collateralized system. I think what we're seeing today is in some of these banks, under collateralization. But in both cases, what do we have going on? These are centralized entities, and they're not transparent. Certainly when it came to FTX, not at all transparent. Centralized, opaque, completely opaque. The banks have to do more disclosure, so they're not as opaque. You could see that they were upside down in terms of interest rates, having to pay up for deposits, but earning a very low yield to which they committed at a bad time when interest rates were very low, thinking they were being smart. And so this is nothing to do with crypto. In fact, Silicon Valley Bank, I don't think you're good to see a mention of crypto at all there. So it has nothing to do with crypto, but it does have something to do with what happens during banking crisis. Usually these banks are upside down. They start losing deposits. In the case of Silvergate and Silicon Valley Bank, there's a run on the bank. When you get Peter Thiel and other famous investors and well-respected investors saying, get your money out of there, they're going to take the money and run. And so this is nothing to do with crypto. This has everything to do with Fed policy, we believe, taking interest rates up so dramatically, the most rapid rate in history, and taking money growth down from 27% 2 years ago to -3. So that's a 30 percentage point swing. That has never happened. We've gone back to the Great Depression to see if that was the case back then as well. It wasn't. And so I think we're going to see more ramifications, but each one of these is a reminder to the Fed. And I think the Fed's rhetoric is going to change pretty dramatically during the next 3 to 6 months. So hopefully the market began to see this and expect it, meaning the other side of the interest rate move to the upside. The market in the equity market in January began to anticipate that the Fed was going to lower the rate at which it was increasing rates, which was true. It did, 25 basis points. And this crisis, I think, was caused by hawkish talk from Chairman Powell this week, suggesting, wait a minute, are we going back to up 50 basis points? And I think that's caused basically a run in some banks, but very specific banks with customer concentration or loan concentration with a particular group of entities. So it seems like crypto has been blamed for everything since last year, but actually that what has happened with the Bitcoin and Ethereum blockchains is they serve as proof of concept. They have not stopped. Transactions that were supposed to take place are taking place seamlessly. And, the health of the network is still very strong. Short-term signals, on-chain signals, might have turned a bit negative because crypto's not immune from liquidity pressures generally in the traditional world. But this idea of decentralized and transparent which we believe is going to support digital wallets, it has just gotten more of a proof of concept. More centralized entities are going under. They don't skip a beat. And we do believe that the financial system is going to evolve more towards digital wallets, which are involved in decentralized and transparent networks that are going to maintain their health. It's the transparency is the reason they are remaining healthy. The S&P down 6%. And the worst performing sectors, again, the market is beginning to recognize everything I've just talked about in the banking sector. Real estate and financial services both down about 10%. The best performing, consumer staples, down 3%. Industrials, technology, all of them down 3%. So in the fixed income market, we started the month of February at about 3.5% on the long-term bond yield. It went up to 4.1% very recently. Now, as of today, we're down to 3.7%. So a slight increase over the month, despite the Fed sounding very hawkish. I always look to see if there's trouble brewing out there more broadly in something called the high yield spread. So the spread between junk bond yields and treasury yields. So that started the month of February at 4.5%. So add that to the 3.5 and you're at 8% for junk bond yields. Today, that is at 8.6%. So the spread is at 4.9%. Now, just to give you a frame of reference, in last October, before bond yields peaked, that number, the 4.9, was as high as 6.1. And we were beginning to get worried. In the coronavirus, the depths, it was close to 10 percentage points, and during 08-09 it was 20 percentage points. So 4.9 is not in crisis territory. It's kind of at the midpoint, I would say, of where we've been over the last maybe 10 to 15 years. So, but we'll watch that carefully. Commodity prices and other prices. Well, let me give you, I've got some of them here. If you look at the commodity prices from lumber to gold, you'll see that they're down, in the case of lumber, from its peak 79%, gold is down 11%. If you look year over year, most prices are down, and down significantly for many of them, on a year-over-year basis. So lumber's down 73%. So this is year-over-year, which we'll get into the year-over-year inflation indicators with time. You've got DRAM, which is semiconductors, down 56. You've got oil down 30. You've got silver down 22. Corn, even corn, down 16%. Copper's down 11%. Gold is down 8% on a year-over-year basis. And what I like to remind people is, I think gold is one of the best inflation gauges, and it peaked way back in August of 2020, nearly $2,100. It's around $1,850 now, and it's been really in a trading range. And that's where we want it to be. We want price stability. So even lithium prices, I know a lot of people are talking about shortages of lithium because of the boom in electric vehicles. They've dropped 10% in the last 2 months. And Bitcoin in really less than a month has dropped 20% from its peak in February at 25,000 to a little bit below 20,000 now.